Hi, this is James Eng of Old Capital. And today, for this May 2022 update, we're going to be starting with the buyers and sellers looking straight at each other in a stare down, seeing who's going to flinch first. And the brokers, whether they're mortgage brokers or listing brokers on the left-hand side, trying to make sure that these transactions make it to the finish line and to the closing table. We're going to be talking about how the cost of debt is impacting investors and thus the price that they can pay for some of these assets. Let's jump straight into it. So we talked about, higher inflation driving higher interest rates and the impact to investors, right? For buyers, your debt service increases, your interest rate caps increase. It's harder to refi into Fannie or Freddie, and thus you're starting with lower leverage that on these bridge loans now. And so last month we sort of alluded to, buyers might not be able to pay full whisper price in today's market. And now the statement is buyers are not paying full whisper price in today's market. So it might be 5%, 10%, 15%, depending on sort of where the seller's cost basis is and how much time they have left on their current loan is going to drive some of that. So that's what we're going to be talking about. Today's update is sort of the market where it's at, sort of what you need to be focused on as a buyer, as a seller, and then someone who's thinking about just holding through this market, some of the things you need to think about in terms of the financing market as well. So my background, born and raised in Houston, went to school at UT, been up here in DFW since 2006, started as an underwriter at GE Capital, and then in 2015 moved over to focus more on the multifamily side with Old Capital, originating 1.2 billion in loans, investing in probably 30, 40 properties across DFW, Austin, San Antonio, and DFW, obviously. And so this is what we're going to be talking about, the capital stack, right? So if you look on the left-hand side, majority of your money for these deals is coming from your debt, right? So 65, 70, 75% of your money is coming from your debt. And the debt is really driven on two things, right? So on fixed rate, it's based on the 10-year treasury. That's essentially gone from 1.5% all the way up to about 3%. So doubled since the beginning of the year. And then the other part of the stack is SOFR, which is what floating rate is based on. That's sort of your base rate. And then you have a spread on top of that. And so that is essentially straight up to combat inflation. So they just raised the rate again, 50 basis points. So you're probably 75 to 80 basis points right now in SOFR. And then they're expecting it to get up to 2.5%, let's say by year end. And then by next year might be at 3%. So really your debt options right now are you have floating rate bridge, which is close to 70%. You have fixed rate bridge, which is close to 60%. And then Fannie and Freddie at 50%. And those are sort of your levels right now. And it's really based off of going in debt yield or debt service coverage. And so that's what we're going to be talking about on the next slide. So we take a deal, let's say a deal that's $10 million, you're buying it at 3.5% cap in today's market. A bigger deal, just multiply it, same numbers, right? So in place NOI is 350. A floating rate bridge, they're going to want a 5% debt yield. So they're at about 7 million on your initial fund. Fixed rate bridge, they want a 6.5, so they're about 5.3, and then Fannie and Freddie, you're at 4.3. So LTV of about 70% on the float, and then fixed rate is about 55, 60%, and then Fannie and Freddie about 44%. So in this case, I mean, just going from your floating rate bridge to fixed rate bridge, that's $1.6 million in additional equity you have to raise. And so, if you're buying $20-30 million deal, that just multiplies. And then, when you start looking at these potential for cap rate expansion, your purchase price might go down. So if you use a 4% cap, NOI is the same, 4% cap, that's 8.75, right? And so the floating rate bridges can get back up to 80%. Fixed rate bridge is about 62%, but Fannie and Freddie are still stuck at 50. And so that's really going in how these lenders are looking at these deals and trying to figure out what we can give you on these transactions. They also look at, all right, I understand where your in place is today, where you're going in to yield is today, but then on your exit, what can you get to? So what debt yield can you get to? So if you assume on this deal, you've got, 75% of purchase, 100% of rehab on this deal, is $23.6 million loan. At 1.7, they're getting to 1.7, then they need about a 7.75 debt yield to exit right now. So on this particular deal, sorry, let me say that again. So at 23 million, 625, they would want close to a $1.8 million pro forma NOI, but your pro forma right now is only getting 1.7. And so based on 1.7 and a 5% interest rate, they can only give you $21.5 million. And so they're looking at not only your going in, but then your exit. And so the higher this interest rate goes, so before last year, it was really based on, let's say 4.5%. Now it's based on 5.25 interest rate, because 10-year treasuries run up so much that they can only give 68% of purchase, 100% of rehab, because Fannie and Freddie are making sure you can, or the bridge lenders are making sure that you can exit for Fannie and Freddie. So they're looking at your in-place income, and then they're also looking at your exit on these bridge loans. All right, so from a buyer side, I mean, prices are down. That's good, but there's going to be a lot of properties on the market, so you're going to have a little bit more flexibility in terms of what you can bid on, and then also how much hard money you can put down, and then also potentially having financing contingencies, ways to get out. Like things like before, you looked at one model unit and you had to put $500,000 down hard day one, right? So now you're going to have, maybe you might have an access agreement, you might have a little bit less hard money, you might have financing contingency. So buyers are going to have a lot more power in today's negotiation, but your debt is still available, but it's going to be lower leverage, right? So on the challenging side for buyers, interest rate caps are very expensive. 2% of the loan amount at 2% strikes is pretty common right now. Your debt service is going to increase if you have a floating rate. Your cash on cash is going to be a little bit lower because insurance, taxes, all those things are higher, and then cost of materials is going up as well. So, all right, so this is what we're going to cover: interest rate caps. So interest rate caps are really driven by a couple things. Number one, how long of a cap you buy, the strike rate that you choose, so the max SOFR that it can go to, and then your loan amount, right? So this is a $10 million loan. The cap is about $245,000 at 2% strike. So right here, $245,000. And the way this works is essentially until SOFR gets to 2%, they don't pay you anything, right? So it's insurance, right? So if it sits below 2%, as this is projected, let's say in the next 5 months, you don't get paid anything, right? But then as soon as it goes above 2%, so this is 209, then you're going to get 0.09 times your loan amount divided by 12. So it really starts paying out towards the back end of the curve, and this is where that forward curve that we're seeing, and this is just an estimate, right? So because the bank has to pay out all this money, so they're paying out $178,000 potentially, they're going to charge you a little bit more than that because they got to make sure they make money. So they're charging $245,000 right now for this cap. Probably 6 months, 9 months ago, when the forward curve was essentially flat, this same rate cap was probably $30,000, right? So it has moved significantly with the amount of increase in the rate. And so this is a cost that buyers have to bear essentially at closing. And so because of that, not only you have higher debt service, but you also have higher interest rate cap. So be prepared for that. So on the seller side, right, some of the good news, your price has gone down, right? Or sorry, some of the bad news, your price has gone down due to this lower leverage, higher cost of capital. But the good thing is that if you have any fixed rate sort of Fannie Mae debt with yield maintenance or defeasance, that prepayment penalty has gone down, right? So your net proceeds might come out to be about the same, but the price that you sell the deal for will be a little bit lower. If you have fixed rate long-term debt, you're still in good position. You don't have to sell right now. The market's still up significantly from sort of pre-COVID, and then if you do sell, you do have money to go out and potentially buy some opportunities on deals that maybe sellers are more motivated than you. So here's a little analysis case study for like when 10-year treasury goes up, the borrowing costs go up, which we talked about from Fannie and Freddie, but then also your yield maintenance penalty goes down, right? So we took this $5 million deal at the beginning of the year. Let's say your note rate was 4.5%. The 10-year treasury was 1.5%, approximately, and then you still had some term on the loan, so it was about $1 million, right? So, but then now 10-year treasury has essentially moved up to about 3%, and then your yield maintenance has dropped by $500,000. So that allows you to potentially pass that on, right? So we showed that example of the $10 million deal that you're selling. It's not going to be one for one, but if cap rates go up and you have to accept a lower price, you are getting a little bit of a benefit in your yield maintenance. So that's one thing to keep in mind as you go through the process of some of these deals. And then, if you're out there and you're like, look, market's down, why do I need to sell right now? Right. So you still have good lease trade outs on your rents. You have, relatively short term, 6-12 month leases. And so you're able to pass this on to your tenants. And then, right now there is a lot of supply coming, but how long it takes to deliver, I think will be more and more time than people are expecting. And so there's a lot of deals that are in construction right now, but it's going to take some time to deliver that product, and it's going to be significantly higher. So I think people who have the staying power to hold, I think will still be in a great position. Some things you have to keep track of, I would say, if you have floating rate debt, your debt service is going up, right? Unless you bought a cap at a very low strike, your debt service is going up. So make sure you have that money set aside to pay that. And then at the same time, you're going to get a knock on the door from the lender saying, hey, you bought a 2-year cap or a 3-year cap, and we need to make sure you've got money for the next cap. And so that escrow that potentially you do monthly with the lender is going to increase. So be prepared for that. And then if you do have a maturity, let's say you did a 3-year bridge, you're going to have maturity in 3 years, but then usually at month 12, month 18, you're going to have some sort of debt yield test. And so they're going to test it to make sure you get into a cash flow sweep. So make sure if you do have a bridge loan, as soon as you can start working on your rents, start working on your expenses, start executing the business plan as fast as possible. I would probably start using all that CapEx dollars you have that you can spend. And then as soon as you can, get into a Fannie Freddie floater from there in terms of to make sure you don't have a debt maturity. And so here's the rates right now across the board on the financing side. So bank loans, I think, they're probably going to move up, 25, 50 basis points from where they were based on the Fed's move. So 475, 525, Freddie, Fannie, fixed rates about 525. And then we're seeing a little tightening on the floating side for Freddie and Fannie as well. And the non-recourse bridge, 4 to 10%, I would say. The lowest spreads probably right now are sort of SOFR, 350. And then it just goes up from there, just depending on the size of the deal, size of the loan, and the location of the deal. But in Q1, I mean, this is some of the data that's coming out of the Fannie Freddie lenders. They did an okay amount of business, sort of Fannie Freddie, but this broker business is really all non-recourse bridge stuff, right? So this is one Fannie Mae lender. They did maybe $3 billion in Fannie and Freddie, and they did 5.6 in sort of non-recourse bridge. And then this is another Fannie Freddie lender. They did a limited amount in agency volume compared to the bridge loans that they did, right? So there's just a lot of money on the bridge side, but then it's contingent on the securitization of these bridge loans. And so that's where they're seeing a little bit more spread widening in terms of how much capital is available for that source. But Fannie and Freddie, another benefit of multifamily, Fannie and Freddie are always going to be there. And so if there is a little bit of tightness in how many lenders show up for the bridge money, then Fannie and Freddie will be there. So, when we're going back and looking at, this chart, Freddie and Fannie, pretty low leverage right now, just based on debt service coverage. non-recourse bridge, you have a floating rate piece. The bank loan guys are coming back, right? And so I called one of our bank lenders and was like, look, yeah, your phone's going to start ringing pretty quickly here, because number one, you have a fixed interest rate for anywhere from 3 to 5 years. You have no interest rate cap, no cash flow sweep, lockbox, low legal fees, closing costs, and then you get quicker approval, right? So these guys can typically get a loan approved, let's say in 1 to 2 weeks, and then it's going to be subject to third parties, appraisal, environmental, things like that, but they could close in 30 to 45 days. And this is going to provide a lot of comfort to sellers when they're in between buyers. All right, who should we choose on this deal? Is it going to be the guy who hasn't raised the money? They're going to go out and get maybe like a non-recourse bridge that's based on the getting securitized. Or are we going to go with the guy who's going to put 40% down? He's going to get a bank loan and he's already approved. Like most sellers, if they want execution certainty, they're going to go with guys who have these relationships, going to go with recourse bank loans that are already approved, ready to go. So here's a snapshot of closing costs at recourse bank loans, which is about 3%. And then non-recourse bridge loans, you're having to pay for that interest rate cap, which is about 2%. Your legal's higher, your third parties are higher, things like that. So you're probably closer to 6%, so almost double. And so as you look at deals, we're a little under $10 million in loan amount, maybe 15 million in loan amount, then that recourse bank loan is becoming more and more important. In terms of Fannie and Freddie, they both have, I get different numbers everywhere, but approximately 80 billion. So 78 billion, I think, in 2022 to lend. And in the first quarter, Fannie did about 16 billion and Freddie about 15. So, if they were going to do the correct number, equal amounts, they'd be about 20 billion. So both of them are short right now. And then I think in the second quarter, the feedback I've been getting, and just from what I see in the market, is their second quarter is going to be lighter than the first quarter, right? So I think they're going to be way behind. And then if you look at the Q1 pipeline for Fannie and Freddie, the 2021, sort of what happened, and they really start ramping up in the second half of the year. So I think that's similar to what's going to happen this year. They're going to have to be aggressive, and some of the things that we're seeing them do is they're going to tighten up their spreads, right? So let's say 10-year treasury is 3%, and usually it's a 200 over spread. Maybe they go to 175, right? And I haven't seen this quite yet, but potentially lowering their debt service coverage from 125 down to 120, maybe 115, and then maybe even increasing their amortization from 30-year to 35-year. So your debt service shrinks. They're going to be focused on affordability and more experienced borrowers. And so if we look at that example, let's say the pricing on that $10 million deal drops to 8.7, and the regular 125 fixed at 5%, 30-year AM, you get to 4.3, which is about 50% leverage. You make all those changes, you go to 115, you go to 475 fixed, 35-year AM, you get up to 60%, right? So that's all of a sudden starts to look pretty interesting compared to your fixed rate and floating rate bridge stuff out there. So hopefully Fannie and Freddie can figure this out, and they will be. And I think for affordable deals, for experienced borrowers, they're gonna push a little bit more. And so depending where the market goes and where the cash flow goes, that might improve. So, all right, let's flip over. So we talked about recourse bank loans. We talked about Fannie and Freddie. Now let's get into bridge lenders. So bridge lenders, obviously, their starting rate's going to be higher nowadays. They're going SOFR plus 350, 375. SOFR's already at 80 basis points. So your starting rate is really 4.5 almost already. They are seeing a little bit more pressure on the CLOs. So those investors are wanting higher spreads, and so they're going to charge higher spreads to you as the investor. And then these interest rate caps, we saw the picture before. It was essentially 2% of the loan amount for a 2-year cap, but then if you want a 3-year cap, it's probably going to be 4% of the loan amount, right? So we're seeing lenders be more aggressive and say, hey, look, maybe take a 1-year cap, maybe escrow for the cap, like different ways to structure it, so that's a big closing cost that you have to put up. but it mitigates your risk and the lender's risk. So here's some of the transactions that we closed in Q1. Majority sort of non-recourse bridge across this. I think we got one Freddie, lower leverage Freddie on this sheet, but non-recourse bridge still is dominating sort of the market. And I think it is going to be the same for Q2 in terms of non-recourse bridge, but the leverage is going to be a little bit lower. So most of these deals probably were done at 70, 75, and now going forward, they're probably going to be closer to 65, 70% on non-recourse bridge. But Old Capital is a mortgage broker, so we're going to essentially take it out, look at your Fannie, Freddie bridge, CMBS, HUD, all those different options when you win the deal, and during the deal, we're going to really represent you in front of the lender, make sure you're getting the best deal, best transaction that's out there. And then sort of after you close, helping you with asset management, any loan servicing, any of those items. And so I think we do a great job sort of before the deal, during the deal, and after the deal, above and beyond most mortgage brokers, most direct lenders out there. So in terms of next steps, definitely subscribe to the channel if you like the information you have seen, like the video. And then if you need help with a specific deal, definitely send me T12 rent roll, OM, whisper price. I can review it, give you feedback on what exactly we could do. And then if you get a deal and you're like, hey, I don't really understand the debt this GP is using, feel free to send that over. I'll take a look at the package and give you some feedback. And then if you're just getting started, you don't have a deal, you don't have anything going quite yet, but you want to see what you can qualify for, definitely send over a personal financial statement, and then we can set up time to sort of talk through your portfolio and potential ways of getting into multifamily. And then if you're interested in joining Old Capital, we're constantly looking for great people, whether it's originators, whether it's administrative support. Just send me an email sort of with what you're looking to do in your resume, and then I will get back to you. So appreciate everyone coming on and listening today. Thanks. Bye.